Hello everyone and welcome to the Quantpedia Explains Trading Strategies video series. Today we will discuss systematic hedging of the cryptocurrency portfolio.
Hello everyone, my name is Radovan Vojtko, I'm CEO and the head of research at Quantpedia. What's today's topic? Today we will discuss cryptocurrencies. So let's get to it. Firstly, cryptocurrencies are already one of the major asset classes. So they are not some obscure small asset class. They fill the top pages of magazines. They are topic of day-to-day conversation. There are a lot of ways how to buy them through a lot of different channels. But some people, the hardcore hodlers, they like to keep their coin portfolio safe. So they buy a portfolio of cryptocurrencies. They store it in the cold storage. It has a lot of advantages. You will probably not be the victim of the hack. Your crypto coins in cold storage are probably safe. But it also has some disadvantages. Your cold storage device can become unreadable or destroyed, or somebody can steal away your cold storage from your safe. One of the disadvantages of the cold storage is that while you hold the cryptocurrencies in your cold storage, you are exposed to price swings in the cryptocurrency market. Those price swings, they can be really big. But you do not need to have that price risk, especially when the market is currently at the all-time high. What you can do is you can hedge the part of your portfolio. And the goal of our article, Systematic Hedging of the Cryptocurrency Portfolio, is to show you how you can hedge part of the portfolio or whole portfolio. Now, we do not say that presented strategy is the only way how to run a hedging strategy, but we would like to inspire you and we would like to show you that there is a possibility to hedge your cold storage portfolio. So what is the setup? So now imagine that you want to parametrically store, let's say, top 5 altcoins. It doesn't have to be top 5, it can be top 10, top 20, or basically any portfolio. So you store this portfolio in a hardware wallet and you want to find this hedging strategy and you want to use the Bitcoin derivatives to minimize crypto market beta exposure. So that's how you can do it. So you can check what is the exposure of the portfolio you have and then you can hedge part of that portfolio by Bitcoin derivatives. So for our setting, we created hypothetical market capitalization weighted top 5 cryptocurrency index portfolio. So it is a proxy for cold storage portfolio, something that the holders may hold. We took the data from 2015 until 2023. We checked what's the top 5 biggest cryptocurrencies at the time. We removed all of the stable coins because it doesn't make sense to hold the stable coins. You want to hold the coins that move freely. So we removed all of the stable coins. We just took the other coins. And then we checked what's the market capitalization at the beginning of the year. And we bought the portfolio for our cold storage that's proportional to the market capitalization at the beginning of the year. And once a year, we rebalanced the portfolio in our virtual cold storage. So these are the crypto coins every year. This is the ranking. These are the crypto coins that we had in our portfolio over those, 8 or 9 years. This is how the buy and hold index look like. And the question is, how to hedge this portfolio. So this is the buy and hold index. It's called T5 index, top 5 index. It's the blue line and the orange line is the Bitcoin. Of course, it's highly correlated with the Bitcoin because there is a lot of Bitcoin in the portfolio, but a lot of the altcoins are highly correlated. So, you can build any portfolio for the cold storage. It will surely be highly correlated to the Bitcoin. So you can use the Bitcoin futures to hedge that portfolio. Now the question is how to hedge it. So first one is we can do the proportional hedge. So we can take your portfolio, we can calculate what is the dollar amount of the portfolio and we can short the corresponding dollar amount of the Bitcoin via the Bitcoin futures or whatever derivatives. What is the graph showing is that there is the spread between the top 5 portfolio and the Bitcoin. What is interesting about the chart is that there is still a high volatility or the volatility in the first half of the sample. So from 2015 until 2018-19 is significantly higher than the volatility of the spread after 2018. Here is how does it look like when we split the sample into two halves. From 2015 up to 2019, the volatility is significantly higher. That's the orange line compared to volatility from 2019, which is the blue line. Why it is so? We speculate, and we are probably right. It's because Bitcoin futures. At the end of 2017, Bitcoin futures were introduced on regulated exchanges, CME and CBOT. From the time, the volatility of the spread gets significantly lower. So, from the time, it really makes sense to run a portfolio and check whether it is possible to use Bitcoin futures for hedging because before that there were some Bitcoin futures but they were not on the regulated market. Then we ran the regression, so we were interested to see when we ran the whole regression for the whole period, what is true beta of the portfolio and what is the correct amount of Bitcoin we should short against our cold storage portfolio. So what was interesting for us is that optimal beta was found to be around 0.97. So to say the truth, we expected higher beta. So we expected that we need to be able to hedge properly our cold storage portfolio, that we have to short more than 100% of the Bitcoin futures. What we find out is that actually it's better or more optimal to short less than 100% of the portfolio that's in the cold storage. That's a little surprising. So the hedge ratio is smaller than 1, not higher than 1. But then we ran done a rolling regression, so we wanted to see how the optimal beta changes over the time. There are significant jumps. When we use the shorter time frame windows, it gives us the lower slope. It leaves us under hedged. We have a higher residual, high beta on the index. I mean, it's not very optimal. It's better to stay, probably 1-to-1. So to hedge, when you have 100% of the portfolio in the cold storage, it's probably fine to short or hedge with the same dollar amount than what's in your cold storage portfolio. That's just a quick introduction, but then we try to build an active hedging strategy. So what's the active hedging strategy? You hedged all of your dollars that you had in the cold storage. You hedge all of them all of the time. And this spread portfolio, that's your resultant return on your cold storage. It doesn't make sense at all because you hold your cryptos in the cold storage because you want to have some performance and not have the performance of 0% over 8 years. So what is the active hedging strategy? You are trying to hedge your portfolio selectively only when there is a high risk of drawdowns. That's the active hedging strategy. For the active hedging strategy, we draw inspiration from our older article, which is called Trend Following and Mean Reversion in Bitcoin. In that older article, we ran some tests and we were looking for ideas how to find the trading strategy using the Trend Following and Mean Reversion rules in a Bitcoin. And we used this strategy as inspiration to build a hedging strategy. So what is the idea? So we propose to include the following rules for the hedging strategy. If I am at the Bitcoin X-day high, I prefer not to hedge the cold storage portfolio. So I hold the cold storage portfolio without the hedge. But if I'm not at Bitcoin high, I hedge the cold storage through some instrument. It can be near-term Bitcoin future or perpetual future or whatever. And I use $1 for each $1 in the cold storage portfolio. I hedge $1 of the Bitcoin futures. So the portfolio is hedged 1-to-1. So those are very simple rules. Firstly, let's take a look what's the performance of the Bitcoin and the top 5 index, so the cold storage portfolio from year 2015 to 2019, and then from 2019 onwards. So here we show from 2015 to 2019, and here is the performance for 2019 onwards. Here are the risk return ratios. So from 2019, which is probably more conservative, the top 5 index had a return around 52% or 50% with a significant drawdown, 70% drawdown, Sharpe ratio 0.76. So high performance, high risk. Significantly high risk. 70% volatility, 80% drawdown. The question is, so let's analyze the alternative strategy that employs the cold storage and it hedges with the Bitcoin futures with the rules that I mentioned above. So we hold the cold storage without the hedge if we are at the X-day high, and otherwise we hedge with the Bitcoin futures. We rebalance on a daily basis, always in a midnight UTC time. And here we have a chart. So let's take a look. So if since 2019, let's say for example 10-day, so we are using the rule that if we are in 10-day high, we do not hedge if we are not on the 10-day high. We hedge the part of the portfolio for 1 day. So our performance is 46%. So let's compare it to the performance of the top 5 index, which is 52%. So we have nearly the same performance. And what is our risk? So our risk, the volatility is halved. So we have only 40% volatility. Maximum drawdown is only 22%. Let's compare that to the volatility of the portfolio without the hedge, which is 76%. So we have our volatility is, quarter of the volatility without the hedge. We had a significantly lower volatility, so halved volatility, and the fraction of the maximum drawdown of the passive cold storage portfolio. Of course, probably the non-hedged cold storage portfolio can have a higher return in the future, but what is the ending, what is the conclusion? It would be really unwise not to consider hedging for at least a portion of your portfolio with the Bitcoin derivatives. Yeah, you can have a little lower returns, but it's not a high price for a good night's sleep. So think about it, at least a portion of your portfolio in a cold storage should be hedged against the moves in the market, because you will have significantly lower drawdowns on your total portfolio, and it's much easier to hold that cold storage portfolio when you have a hedging in place, at least for the part of that portfolio. So I hope that I showed you the way how to do it. I hope that you like the article. Now, if you are interested to read something more about cryptocurrency trading, go to our research page. So we have a direct research page called Cryptocurrency Trading Research. You can get there via our resources subpage. In the resources subpage, you have an internet crossroad to articles about different interesting topics. If you are interested to learn something more, go to our Cryptocurrency Trading Research subpage. We have, a lot of articles about systematic trading strategies, etc., etc. And if you are interested about systematic trading strategies in cryptocurrency market, you can search our database, our screener, through the keywords cryptocurrencies, and you will get over 40 different trading strategies that are related to cryptocurrencies. Thank you very much for your attention. I hope that you liked this video. Please give us the like, please subscribe to our channel, and let's meet in another video. Thank you very much.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.